Hey everyone, and welcome. So I want you to imagine something. What if your investment portfolio paid you like a weekly paycheck? Seriously, not every quarter, not even every month, but every single Friday. Well, today we're going to dive into a new kind of fund that's trying to make that exact thing a reality. Roundhill's WeeklyPay ETFs.
You know, it's a pretty simple question when you think about it. Our bills for groceries, gas, rent, you name it, they show up all the time, right? But traditional investment income? That usually lands in your account in these big, infrequent chunks. It creates this timing mismatch that income investors have just kind of had to deal with. Well, maybe until now.
And this is where this new breed of exchange-traded fund, or ETF, comes into play. These are built from the ground up to try and solve that exact problem, to line up your investment income with your actual real-world expenses.
The company making all this noise is Roundhill Investments. They've rolled out a whole suite of products they call WeeklyPay ETFs, and that's what we're going to break down today. We're talking about how they work, what they're offering, and of course, what the trade-offs are.
So what's really interesting is that instead of tracking a big, broad index, each of these ETFs is built around a single, super popular, and often pretty volatile stock. We're talking about the big dogs here. TSLW for Tesla, which everyone is always watching, NVDW for the AI powerhouse NVIDIA, and even AAPW for the giant Apple. The whole idea is to squeeze high income from the stocks you're probably already following every single day.
Okay, so how on earth do they generate enough income to send out a check every single week, especially from stocks that might not even pay a dividend on their own? Well, the secret sauce is in a pretty unique option strategy that's, believe me, very different from what you're probably used to.
And here it is, the core of the whole thing. Forget about a typical income play like covered calls, which can cap your gains. These funds use options to aim for a slightly amplified return. They're targeting 120% of the stock's performance each week. So if the stock goes up 1%, the fund is aiming for a 1.2% gain. It's that little extra slice of performance that generates the cash for that Friday payout.
So let's break that down nice and simple. First, they pick one of those big-name stocks, like Tesla. Second, the fund manager uses options contracts to build a position that aims for 1.2 times whatever that stock does for the week. Third, the income gets generated from that amplified move. And finally, boom, that income is paid out to you every single Friday. It's just this constant cycle of generating and distributing week in and week out.
All right, now for the part that really matters to any investor. This strategy sounds pretty powerful, right? But it is absolutely crucial to understand the two sides of this coin, the potential rewards versus the costs and the risks that come with it.
And let's start with the payoff, because wow, it can be massive. Take the Palantir-based ETF, for example. It's shown a dividend yield of nearly 35%. I mean, that is just an eye-popping number, way beyond what you'd ever see in traditional income investments. It really shows you the raw power this strategy can have. But, and this is a big but, that incredible yield comes at a price. The annual expense ratio for these funds is 0.99%. Now, that's a lot higher than your simple index fund. You're paying for the complex, active management that it takes to run this kind of option strategy day in and day out.
And you absolutely have to understand the risks. While the strategy targets 120% of the weekly move, over the long haul, this structure can actually cause the fund's total return to lag behind just holding the stock. That extra exposure also works on the downside, meaning your losses can be bigger too. Plus, the high payouts can lead to something called NAV erosion, which just means the fund's share price itself can shrink over time. And finally, those weekly payouts, they're usually taxed as ordinary income, which isn't as great as the rate for qualified dividends.
So where does this unique approach really fit into the bigger investment world? I mean, it's not like just owning the stock, and it's definitely not like a typical income fund. It really carves out its own little niche.
This table really shows the trade-offs pretty clearly. Compared to just holding the stock, you're getting a much higher yield, but you're also taking on more volatility. And compared to a covered call fund that puts a ceiling on your upside, this strategy keeps that weekly upside open. It all points to a really specific use case. This is for an investor who's already bullish on a stock and wants to generate high income from that optimism.
Now, for those of you who follow high-yield ETFs, the name that probably comes to mind is YieldMax, and online investors are definitely comparing the two. The general feeling is that YieldMax funds might offer even crazier yields, but the trade-off is a bigger risk of that NAV erosion and more variable dividends. Roundhill, on the other hand, is seen as offering a more stable and predictable ride.
And don't just take my word for it.
One investor on Reddit who's held both types of funds put it just like this. They felt Roundhill offered a better balance, giving you more stability and predictability than some of its ultra-high-yield competitors.
So, after looking at the strategy, the rewards, and the risks, we get to the million-dollar question, right? Who is the right kind of investor for a product like this? Is it you?
The perfect investor for a WeeklyPay ETF really needs to check all these boxes. You have to be bullish on that specific stock, because if it tanks, your losses are going to be amplified. Your main goal has to be income. You have to understand the risks of that 120% exposure and be cool with the higher fees. And finally, you might pick this over a competitor if you value that relative stability in the fund's price and its payouts.
And just look at the yields for some of the most popular funds in the lineup, like for Coinbase, Tesla, and Palantir. You can see this clear pattern, right? They're all hovering in that incredible 35% range. That consistency across different kinds of stocks is a huge part of their appeal.
And all of this brings us to one last forward-looking question. Roundhill pushed the boundary from monthly payouts to weekly. So does this open the door for the next logical step? I mean, could we one day see funds that pay out daily? It's a fascinating thing to think about, and it makes you wonder where the future of income investing is really headed. Thanks for tuning in.